For more on this now, Beth Hammack, Global Treasurer at Goldman Sachs, and also the chairwoman of the Treasury Borrowing Advisory Committee. And you guys off camera were talking about the latest repo things, right?
Woo-hoo!
How was it? We like viewers. Therefore, we try to do as much on repos as we possibly can because they're clamoring. They're clamoring for more. Actually, it is important. How was it today? And would you say that there's anything analogous to what happened 10 years ago or not?
No, this is definitely not a credit crisis. There's plenty of liquidity available in the system. It's just a matter of getting the cash and the collateral to exchange places. And the Fed's really done the right thing by stepping in here.
Okay. It just coincidental that it's happening as we hear of all the strains in terms of negative yields and things that, we're easing at 2%. It just seems a little bit strange, doesn't it?
Well, I think
is it pushing on a string, the worry, or what's the real concern?
No, I think the real concern, and this is something, as Steve said, that the Fed has known was going to happen. So they've been watching this market very closely. As they've been reducing their balance sheet, the amount of excess reserves in the system has been declining. And they knew they were going to hit a point where they'd have to start growing their balance sheet again in line with currency growth and in line with broader needs. And so it feels like we've just hit that point. We knew it was going to happen somewhere between $1 trillion and $1.5 trillion. And on Monday, because of the corporate tax payments, because of the bill settlements that happened in the marketplace, we hit about $1.35 trillion, and that was really what drove the repo rate higher.
Were there also technical aspects involved with this in terms of yield steepener trades funded by the repo market, and with the Fed stepping in, are we just funding a popular hedge fund trade that's been put on?
So I think there is a part of the story that hedge funds have been more levered. They've been buying their treasuries with leverage by borrowing those funds. And that's part of what's driving this need for the cash versus a collateral. I think what you're finding is that the size of issuance by the Treasury right now, the marginal buyer of treasuries is a levered buyer and not a cash buyer.
Beth, I think it may be worthwhile to take a step back and explain the situation, as we're sort of living through an important piece of history here, right? The Fed has this new massive balance sheet. That's on one side in terms of how much is out there. Also have the new Dodd-Frank regulations, which require banks to keep a certain amount of what's available over here sequestered away and to use to make regulations. Nobody knows what the right level of any of this is. The Fed doesn't know what the right level of reserves is in the system of the Brave New World, and nobody knows what the right level of regulations are for the bank. So when you think about ways, how do we fix this? Is the Fed going to need to keep coming in and putting $65 billion, or can we adjust the regulations? Are there things that we can do so that I don't have to sit here at 8:31 every morning and tell people you got to worry about this, or you don't have to worry about this when it comes to the repo operations?
Yeah, and I don't think the Fed wants you talking about this at 8:31 every morning. So I think they do need to put in place a more permanent solution, and there are a couple of options out there. One is they could grow their balance sheet, as they've talked about doing, either by buying bills or other types of treasuries. The other, which is something the FOMC has been looking at for the better part of the year, is putting in place a standing repo facility. Something that would be available for the primary dealers and the banks to take advantage of if they needed it. But like you saw with today's operation, when it's there and you know it's available at all times, you tend not to need it quite as much because you have this sense of calm in the system. And so I think what you saw with today's operation, $65 billion being accepted, but $75 billion offered, the announcement that they were going to keep being in the market through the middle of October, and in those operations for the rest of the week, it would be at least $75 billion, gave the market confidence that it didn't need to use it.
Because Joe is right. Nobody wants to talk about repo until they have to know about it, right? And it was bigger than a canary, right? It was like a massive animal in the coal mine.
Like the muscle memory, right?
It was the thing that blew out, and everybody has this natural reaction of, well, wait a second, this thing's blowing out. So,
but importantly, in 2008, the things that were being repoed were not U.S. Treasuries. And so what the concern was in 2008 was about the underlying collateral that was being pledged. No one's worried about U.S. Treasury credit at this moment.
Why wouldn't the Fed create a standing facility at this point? I mean, they've been debating it since June, at least?
It's just operationally complex. I think the facility they're looking at is an intraday facility, and I think they got to get the pipes working, and that takes time.
So address what's going to be on Twitter right now, which is, it's QE again. Is it quantitative easing? They're growing the balance sheet. They're buying bonds. Why isn't it quantitative easing?
The Fed's balance sheet has always grown. It grew up to about $800 billion ahead of the crisis. Then as you got into QE coming out of the crisis, they grew it much more significantly. They used to operate in a different system for controlling rates back then, pre-crisis. They operated in what they called a corridor system.
Right.
They've now said they want to operate in this floor system, which means they need to have an abundance of excess reserves.
So did the Fed get it wrong? Did they make the balance sheet too tight when they brought down reserves?
I don't think they got it wrong. I think they knew they were going to hit a moment, and as soon as that moment happened, they stepped in and supported the market. So I think they did everything right in this instance.
So you would say that central bankers around the world have a good handle on the situation, on everything, right? No one's losing control, no one's pushing on a string, everything's great.
I think we're in a good place. I think they are watching things closely.
Okay, that makes me feel better.
No. I think you're asking a different question, Joe. I know we probably have to go here, but I think you're asking about monetary policy. I think Beth was answering about the repo market.
No, I know, but I'm just trying to bring it to broaden it to a bigger conversation.
Yeah, I think that's a good question.
This is the new normal, as Muhammad would say. Not, Muhammad Al-Arian, I should point out. But, this is weird, is it not?
I think the repo market is a highly technical
market.
Not
repo, 16 trillion negative, still headed lower, all that stuff.
Yes, but that's not a U.S. problem. That's a foreign central bank
well,
problem.
Whoever's problem, it could eventually be everybody's problem.
Is Goldman preparing for a day when U.S. rates are negative?
We prepare for many different kinds of eventualities, and certainly negative rates is one that we think about, although I don't expect it to happen in the U.S.
How about zero?
We've been to zero before. We're prepared for zero.
Really? Okay.
We don't like zero, but we're prepared for zero.